All right. Good morning, everybody. Hey, I got a little weird signal, so if somebody can just let me know that you can hear me, we're all good. We'll get this thing started. All right. Thank you. Yeah, that was weird. Doesn't matter. How y'all doing today? We made it back. Got the start of another week. We're still in a government shutdown because why not? Right? History has been made so many times in the last 2 years. Why not try to go for a new record on how long the government can do nothing and uh, and do it publicly? We have FOMC week. This is a tricky one. A lot of times, FOMC weeks give us this hurry up and wait module. That's what I've called it over the years, the hurry up and wait. Everybody gets all fired up and excited and they want to see it. That's a really good thumbnail, bro. I like it. Well, he's got skill. I have no artistic skill whatsoever. Talk about admiring people. I definitely admire artists because I can't draw stick figures, let alone anything else. FOMC week always has this expectation of big moves. And sure, when we finally get to the report on that day, a lot of times we do get those big moves. But what we get on Monday and Tuesday a lot of times is nothing. We sit around and go sideways. But there are exceptions to this. And I found those exceptions by going in the past and marking out FOMC days. That looks like something my grandbabies would do, except you stayed in the lines a lot better. On these exception weeks, while everybody was sitting around thinking, oh, it's not going to do anything because we're just going to go sideways into FOMC, the market actually break out and it runs all the way to the edge of the weekly expected move, typically on the first day, like on Monday. And then Tuesday, we retrace it or we hang it and we just sit there consolidating. So while it's easy to just say, yeah, it's going to be a sideways week because it always is a sideways week to start everything out. Be mindful that if we get that breakout and run started, it could just keep going all the way to the edges of the weekly expected move in a single day. And think about that. That's the range that we were supposed to cover for the entire trading week, and it can make the move in a single day. It's not unusual either, by the way, right? We can go from the lower edge to the upper edge in a single day. So if you want to understand what price can do on any of these economic events, CPI, PPI, non-farm payrolls, FOMC, start by Googling the dates. When did they happen? And then go back and mark them on a chart. Save your work. It's one of the reasons I like Thinkorswim is because you can save different layers of drawings. So you can draw on it all you want and then hide those drawings so that they're not obscuring your price action. And then you can turn it on and off as you wish. By marking those days out on the chart, you can go back and look at what a particular stock did during the FOMC week, and it just helps you better understand what we are expecting. So my base case argument is a hurry up and wait. The market didn't like that idea though, because we're up this morning already, right? So we'll see where we go from here. There is a 25 basis point expectation for this week. That's been baked in. There's really no doubt that we're going to get this. And I heard some people saying they thought it would be a 50. We may need a 50. I'm not arguing that we don't need it, but if we was to get a 50, that would spook people, right? And they don't want to scare the markets. So giving what was already telegraphed is really important just to maintain decorum, I guess, right? When you have a building on fire, you're not supposed to yell fire and then, start a panic and everybody runs towards the exits and tramples everybody. You have to, whatever that word is, you got to stay stoic, right? They don't want to freak everybody out. So even if there are some really big underlying issues, I wouldn't expect a 50 basis point because it would just create panic, I think. So that gets us through this week. And it's really going to be the hot topic of the week. It's overshadowing, this government shutdown, which hasn't gotten the kind of attention that I thought it would get, honestly. I mean, I don't live in a bubble. I've got access to a lot of different media and news, and they're just getting a free pass. And they meaning the government. I'm not picking sides. I don't have a dog in that hunt. As far as I'm concerned, they're all culpable. Some big words on a Monday. So this is our projections. You can find this page if you go to Google and just type in FedWatch. It's the CME Group FedWatch tool. It's free. It doesn't cost you anything. They have Twitter if you want to track them there. And this is not the only place you can see this. And you can get it looking differently, right? They've got charts and tables, and you have fun, play around with it. The main thing is to understand, are they pricing in a cut? And if so, what's the probabilities of that cut? And then, of course, you can go out to dates farther up the line and see what's going on there. And don't forget that next week we have QRA. And I know that one's kind of new to a lot of people. It's confusing, but it's a really big deal. And it doesn't generally show up on any of the calendar scheduled events, right? They just don't cover it. Maybe because it's obscure and confusing, and I don't know. But slowly over the years, they're starting to talk about it a little bit more. Like I think I seen it on Finance Juice last quarter. So maybe we're going to start to see it show up more and more. Maybe. Markets are up this morning, led by the NASDAQ. Right behind that was small caps. I found that interesting this morning, how usually what we've been seeing is small caps up, tech lagging by a lot, or tech leading and small caps lagging by a lot. And this morning they're both running. Of course, basically everything is running. The Dow is not up the most. It's up the least, but it's still up 0.5%. So it matches our benchmark. This calls into question that hurry up and wait program that we were looking for. All right, so we can see the asterisks here on durable good orders and durable goods minus transportation. It has this little asterisk. And if you scroll down and look, data is subject to delay if the government shutdown continues. Well, it did continue. So, we'll get what we can get out of it, but I wouldn't expect much. We've got some auctions today, all up in the front end. So you could use like, I don't know, IRX if you want to just kind of consolidate all of that. Don't discount how important these front end auctions are, right? Especially when it goes to our perspective of liquidity and whether or not spreads are widening and there's any sort of a liquidity issue. There's multiple posts on Finance Juice in the morning. And if you have Pro, they have other announcements that go through on the audio that don't necessarily show up in the print about the repo operations. So maybe kind of keep an ear out on that stuff. I don't think anything is going to match that Jackson Hole mic drop moment that Powell gave in 2022. That's going down in the history books. There is a change in dynamics out there. Gold continues to be weak, and miners, I don't see. Oh, there's silver and silver. So precious metals continue to fade off of that high. Um, there's a limit to how much this is going to be allowed to fade before it's not just a pullback anymore. And that's been the drumbeat. Everybody's been consoling everybody else and hyping up the crowd and reminding everyone that it had to pull back eventually, right? Trying to convince each other to maintain those diamond hands. But at some point, you have to just realize that it's not just a pullback anymore. So how far does it have to pull back before we begin to trigger that exodus? I don't know. Place your bets. Yeah, that's right. Nothing to see here. It's supposed to do that. This blue line on this weekly chart is a sloppy mean, right? So a mean can be defined as a fair price or average price. I don't really like to use those terms, but it does fit. If we break the mean, we are no longer in trend. That is a really good way to look at things. Now, down below, I've got the MACD. We're well above zero, and we haven't crossed over yet. Primary is still above secondary, and we're still above the zero line. So the long-term trend is intact. The secondary trend is intact. We have no weakness signaled on this lagging indicator, and price is still above the 10-week. So we're still in trend and still above the mean. But that is a really good line in the sand. If we get below that, the trend is broken. Now, take that into context. A trend can be broken. We can be no longer in an uptrend and then it's broke. That does not immediately put us in a downtrend. There are some analysts who believe we are always in trend. And if it's not going up, then it's trending down. And I'm not a big fan of that approach, but it does exist. I like to add another category, where we got the uptrend, we got the downtrend, and then we just have no trend. Chop. If we get below that blue line, that does, in my opinion, kill the perspective that we're in a trend to the upside. We would have to see what happens from there to define whether or not we're actually in a downtrend. And trends can resume again even after they get broke. So we could break the trend, stall out for a month or 6 weeks, and then we could begin a new trend to the upside or a continuation to the upside. Depends on how you want to define whether if it's new or a continuation, but it could just continue to go up, whatever we want to call it. As a previous example of a big bar that pulled back to the 10-week, we can see back here. It's not a great example, but there was a sharp pullback to the 10, and then we gapped down under the 20, and we roared back to the upside. Another example of pulling back where we got below the 10 and we came back up again. So, this thing has a history of recovering and continuing to go. What I would be looking for are some basic signals that have provided valuable over the years. Lower highs, so a run back up that fails to match or exceed this previous high and puts in a very definitive lower high, start to develop a topping pattern here. That would be some good signals for weakness. Kind of like what we did on the daily, where we popped to the upside and we just couldn't do anything with it, stalled out on the mid and broke down, tried to rally again, couldn't get through the mid, stalled out, fell again. So, these lower highs and lower lows are the definition of technical analysis and reading price action. Put it back on the weekly, we don't have anything yet, just one bar, and it needs to give us more information. So that's where we're at. All right, so we do have our big gap up. I gotta say, a gap at the highs with this shape really makes me think reversal. I will be planning for and trading a reversal today. If you want to wait, I'm not a big fan of waiting, but if you do want to wait, get below this Globex low that we've already established, right? Get that breakdown and then start trying to close the gap. If you can short across the highs, in my opinion, that would be better. But, for an example, you might not have been awake at 2:30 this morning. I was not awake at 2:30 this morning, so you didn't get a chance to short off of that high. I get it. If you don't want to short from the hole, and I'm not a fan of shorting from the hole, then let it break down and see if we get some Busby off of the bottom of this thing, right? The idea being that even if we do break down, we're likely going to pull up. So let it break down, look for that move back against the breakout point, and then try to short it off of that pullback. You could try to trade off of the 50 break. It would be the same idea that we break that level, maybe bounce off of the 786, and on this pullback, try to short it off of that pullback. Otherwise, once we get down to the 1, look for a break of the 1, getting down into like the 1, 2, 3, 6, look for a pullback, try to short it off of that pullback so that you're at least still catching it off the highs for a short rather than trying to get into it as the candle expands below the breakout point. That's user preference, right? You do you. If that's your style, then just ignore me and do what you always do. Either way, this really looks like a capitulation play, a blow off top, fake break, fast failure, whatever you want to call it. Look at it on the daily. Does it have to go down? No, it doesn't have to. And by now, hopefully we've all learned that price can do whatever the hell it wants, and it doesn't ask permission or forgiveness. It just does it. So yes, it could just stay here in the range all day long and do nothing. It could continue to go higher, or it could reverse and come back down. It doesn't owe us anything. But one, it's not likely to stay in this range. The range is too narrow. So while it could just sit here in this box, it's not likely to sit in that box. 2, GTFO, that's the box we have to get out of at this point to do anything else. And then 3, we have to define if it's likely to go higher or lower. But look, if we break out the top and get through the 786 or the 111 and 1236, then it's game on. I mean, that's obviously a continuation, and it's just going to keep going higher. I'll be looking for any reversal off of that 111 and 1236 to play it coming back in again. And on the other side of it, if we break down to the downside, It's the same thing. We got to get through the 111 and the 1236. Only I won't be playing a reversal off of these lows. Right. So I'm not going to play it where if it comes outside of the box that I think price is going to come back in the box. I don't think it will to the downside, but I will be playing it that way if we break out of the top. The call wall rolled back up where it was before. It's not at new levels. It's just back where it was. So the call wall has come down. It went up, it went down, it went back up again. It's still at the same spot. Nothing's changed there. And it's still well overhead. So what we have instead are these other levels, combo lines and gamma lines, and those are going to be in play. We're against one on the upside, 68.92 cog line, and then this gamma level. We got more inside of Friday's price action, then the 3-period moving average, then the 3-week moving average, the 10-day, and then the 20-day right above zero gamma. The volatility trigger and all of that much, much lower than we are. We use the 10-day every day to define how far price has run and has it run too far. Well, another really good metric is the 3-day moving average. It's that white line right there. And how far away we are from that white line matters a lot. For short-term mean reversion sort of stuff, if we outrun that white line, we come back at it with velocity. Think about bungee jumpers who stretch that cord and it's right at the pause point before they turn around and get yanked back in the other direction. That's price trying to escape the 3-period daily moving average. If we get a big move that takes us far away from that white line too far, too fast, we do mean revert with velocity. Makes for a really nice target. So you do you. You can bring up the Qs, the SPY, the XSP, whatever. Whatever it is that you want to play. That's the target, is back to the white line. And if you want to run an overshoot because we don't expect it to just get there and stop, probably needs its brakes checked, then run an overshoot. Like in this case, it wouldn't be 68.22. We'd be aiming for 68.20. One, because I don't think they have a 22 option. They do have a 20 option. But two, because we'd be expecting that it overshoots. And you could do today's options, but if you want to avoid PDT, if you're doing it, on SPY or the Qs or something, just use tomorrow's options. That way you can close it tomorrow and you avoid PDT. I think it would still pan out. I would use tomorrow's options even if you were going to close it today, or something later, right? Like Wednesdays or Thursdays options, even if you were going to close it today. Overnight trading at 78,000, pretty close to 79, really. Yeah, we could just round that all up to 80. It's a little higher than normal, especially for an FOMC Monday. It's a bit of a surprise, but it does show their active participation. So they're in there, they're getting after it. And, other than the gap itself, we haven't done anything all night. So they didn't get much work done. Just chilling in this zone here. We didn't get much of a kill zone. We got a very small zipper pattern crossing back and forth above and below VWAP. It's a bit of reciprocation, but other than that, I mean, we don't have much anything. And this one bar is boss. Got to get through that before we do anything else. Checking the midpoint on that as the line in the sand. So you got your upper zone, the lower zone, and then the breakout points. They just teed it all up on a silver platter. It's a nice gift. It's our ADR lines for today. A break to the downside can put us back inside of Friday's range, but we would have to get below the ADR half to do that. So it's a little odd to be in this situation. Friday's high is now going to act like a bit of a support level, and so is that ADR line. So we got multiple levels of support that could potentially hold us up and keep us from getting back down inside of that range. Support's not a good word to use, though, right? It's forward looking. It is potential support. We don't know if it's going to actually be support until we get down there and check to see if it did support us. Either way, we would expect to see higher trading volume against that level. So you can watch the cues, keep your eye on the time and sales, the positioning within the dome. That's what I meant by the cues, QUE, not QQQ. Keep your eye on the trading cues and see who's standing in line or how much of a line there is along those levels. And then, of course, the pace of the tape as we come into that level, see if they're actually going to get any work done. To the upside, we got 69.61. We could go that high today, and it wouldn't even be considered an outside move. It really seems like 7,000 is on the agenda for this week. Doesn't mean that I think we're going to keep it either. It just it just really seems like they want 7,000. If not, then 69. You know, a new milestone this week seems to be the goal. All right, we did make it through Friday without hitting this pivot point. So that's an MDP, missed daily pivot. So far today, we haven't hit the pivot. That's bullish. We opened above it. That's bullish. Today's pivot is higher than yesterday. That's bullish. But we have this expectation that we're going to hit the pivot because that's what price does most of the time. Most of the time, it just comes on down there and hits that pivot. So being this far away from the pivot and having gapped up that much implies that we could see weakness and begin to roll over simply because of that pivot. I've talked before about how on Mondays, you have to be mindful of how far away we are from the weekly pivot. And that if we open gapped above the weekly pivot by, quote, too much, then we're likely to stall out and come on back down and tag that weekly pivot. But how much is too much? And I've tried to quantify that over the years. Pivots are not moving averages. So the numbers reset every week and it becomes really janky. And I haven't had a lot of luck defining how far is too far when it comes to how far away from the weekly pivot we can get. I went back and hand drew the measurements to try to find, you know, a series of numbers. And it depends on what kind of volatility we had in the situation when it happened. So 2.5%, 3% away from this floor pivot, I start to get a little worried. If we're less than that, I'm not as worried about a mean reversion. And right now, we're not even 2%, right? We're at about 1.5% above that weekly. So this doesn't quantify as having gapped up on a Monday too far away from that weekly pivot. But I did turn on the S&R lines for the daily pivot. And right now we are resting above the R2 line. We don't need to wait to get to the bottom of this level. If this R2 can't hold, we're going to R1. If R1 don't hold, we're going back to Friday's high. If we get inside of Friday's high, we're going to this floor pivot. Underneath the floor pivot, we've got S1, which is the weekly pivot. They're just close enough. So that's that's quantifying what we had already discussed, right? Because that R2 is really close to the mid. But now we just have more context. So if we break the mid or we break R2, it's game on to the downside. And then what I would be looking for is cascading failure. Watch it fall like dominoes across the different sectors and industries. Mag 7, consumer discretionary, chips, cloud computing, just watch them dominoes fall one by one. Then when we get into the open, get the 0-day options flows, everybody jumping in on both feet just to smash this thing lower. Even if it's just a 1-day ripper to the downside, run it back down to the floor pivot, overshoot that, get inside the weekly level. Doesn't mean we need to stay down there, right? And then that'll give us a really wide Monday. And then Tuesday, we just sit and chop inside that really wide Monday range. Makes perfect sense to me. So there's your line in the sand, 68.79. And we've talked about how you got these reversals on the week or even on the day where we can see price run down into a low and we don't see a lot of volume there. And that kind of tells us that there wasn't a bunch of buyers sitting down here that ran it back up. Instead, sellers just got exhausted and price buoyed back up, because price buoys up quite often, right? The analogy is take a ball, hold it underwater. As soon as you let go, it bobs to the surface, right? Because there was nothing holding it down anymore. Price generally bobs to the surface if there's nothing holding it down. The same thing on reversals. If we get to a high and we run into a lot of sellers up there, then we'll see a big volume histobar, like these Schwab bars or a volume shelf. But if we get up into those highs and there wasn't a lot of sellers up there, buyers just get exhausted, we fade back down again because we ran too far too fast. Nothing was there to sustain it. We didn't build a floor underneath it. We just faded back down. So these shallow edges give us that indication. Well, look at the high that we put in on Friday and all of the work that came in up there. And we completely jumped that level. I've often said when price hits something that it can't work through in the regular trading hours, it'll jump it in the middle of the night. I've seen it so many times. It doesn't matter if it's a moving average, an anchored VWAP, a pivot point line in the sand. If we hit something in the daytime that we can't get through, a lot of times we just jump it overnight. And that's what we have here. We hit something, we couldn't get through it, we jumped it in the overnight. But whatever that something was can act supportive now. So whether they were front running 68.50, whatever it was, if we get back inside of this level, we could find support between 68.40 and 68.20 and get stuck inside of this sort of channel or zone. If that breaks, it gets really shallow, and then we find structure around the 67.80 area. Ten-day, 30-minute volume profile and TPO. You know, we were just talking on Friday about how the range was likely to get more narrow now because we were finally getting rid of all those candles that were on the bottom down here. And I said, that'd be cool. Next week we'll come in, we'll have a nice narrow range. unless we expand to the upside. And that wasn't me thinking we were actually going to go to the upside. That was just pointing out that if we went to the upside, we'd expand our profile, and ta-da, we expanded the profile. Now, to be fair, we started to expand it on Friday. You can see that high volume shelf even on this time frame. And now we're above it. And there's absolutely nothing below our own Globex low. So it's not shallow, it's just non-existent. There's nothing there. So jump the gap, and then we've got the structure from Friday. If that structure breaks, we get into the value area, and the point of control at 67, let's just call it 67.80, close enough. We do have a new VPOC from Friday. I'm just going to get it close enough to the point. If you want to get it to the tick, you do you. That's close enough for me. 68.38 is the VPOC from Friday. Yeah, 68.32. To me, it makes perfect sense that we could come down and get stuck inside of this range, and that really defines the low of today. I don't see why we would break that structure and get into the shallow areas, but if we do, then we can cut right through 6,800 and get into 67.92 cog line, which is a VPOC that doesn't count anymore, but it's also a cog line. So these are the new VPOC levels. That is amazing support. $68.25 is Friday's close. On Friday morning, we measured last week's range and we compared it to the projections for this week's range. And at the time, it was coming up a little short, but it didn't count because the market hadn't closed yet. So now we get a chance to do that again, and we can see that this week's range is narrower than last week's range. And that's common on FOMC weeks, CPI, PPI, non-farm payrolls, that sort of stuff, because the market is pricing in the anticipation of hurry up and wait. Implied volatility is forward looking, right? It's one of the few indicators that you have that is based on actual trading that is being put on now and being held for the future, not looking back at old volume or old data or old price action. So implied vol is a forward-looking indicator. And that's where this range comes from. Traders are placing their trades, and we're using that data to define the range. It doesn't mean that those traders are right, anything like that, but there's billions and trillions of dollars that go into these levels. And there's a lot of expectation about these levels. The 68% chance that we close inside this box at the end of the week. And how those traders trade these levels gives us an idea about the expectations. The narrower range tells us that we're supposed to have a hurry up and wait mode Monday and Tuesday going into FOMC. Whether we actually get it or not will be completely different. And so far, this gap up, while it feels aggressive and it seems like we've moved a long ways, we haven't done anything. 69.25 is the week's edge. And we're nowhere near that edge. We're not even above the 6,900 marker. So at this point, this is just another day at the office. Keep your eye on the percent distance of how far the S&P has moved. If we begin to exceed 1% up or down, things begin to change a little bit. Right now, we haven't exceeded 1%. We're not even at 1% yet, so it's not a big deal. But how far the market, especially the S&P, has moved on the day, intraday, is really cool. There's a lot of work and analysis that's been done over the years on intraday price action and how far the move has to move before options traders come in and begin to take advantage of the situation. We're at 0.85. If we get past 1.05, we'll watch the options data a little closer. We're still 3% above the 10-week. It's fine. It's healthy. We're a little higher than is comfortable, but we're not at extremes. This is not enough to look for a mean reversion. So if we was looking at this and trying to answer the question, have we gone too far too fast? Not according to this. But that's a weekly. On the daily, we've exceeded 1.5. 1% is about that collar area that we like. Start getting beyond 1%, and we have to begin considering that we may have gone a little too far too fast. But if we look in the past, I'll just put my mouse where that line, that histogram bar stops. We've been higher than this, and we've sustained moves for multiple days and even weeks higher than this. So getting to even 2% is not an automatic rejection and does not mean that we have to turn around and go back the other way. It often does turn around and go back the other way at or around 2%. We can see many times where it was just a one-day wonder. We got near it and fell back, or we got through it and fell back. We wasn't able to keep it. But there are periods of time where we can get really aggressive and stay above it for over a week. Now, to be fair, this, when we exceeded, was coming out of those April lows, and the president of the United States was on television telling people it's probably a good time to buy stocks, right? And that may have had something to do with all of that buying frenzy and, you know, a little bit of that exuberance. But generally speaking, 2% is a place to begin getting a little concerned about how far we've moved in the short term. Above 2.5, I would begin to look for mean reversion behavior, but it would be on an hourly and or a daily, not on the higher time frames, not the bigger picture stuff. Looking at what's down today, the Mag 7 down volume is down. That's a double negative. And then we've got gold miners, nat gas, and metals and mining. And it doesn't show here, but also precious metals, right? So not just metals and mining with XME, but also precious metals. Gold, silver, gold miners. So all of that is down. On the other side, looking at what's up, chips, Mag 7, Bitcoin, China, quantum, uranium, Mag 7, robots, tech. Even solar is up this morning. Healthcare, banks. We have everything we need for a rally day. Everything. We have everything we need for a rally day. And I've seen this before. In fact, the last time we had this set up, I called the short And then I started to argue against my call out because all the data was bullish. All the data was bullish. The thing is, my short was right. My arguments were too early. We're in the same situation as last time. I think Marziti was live that morning, the last time we had this one. All right. And we were talking about it because I had time to actually pop in and chat that morning. It was a Friday, not last Friday, but it was a Friday. We have every reason looking at the data to think that this is going to go higher. We've got the right sectors, the right industries, the right stocks. We have every single metric and tool pointing to the upside for a breakout and a continuation higher. And yet I'm saying we break that mid, we're going to get this gap closed. And you can run it level by level all the way back down. You don't have to just, hold on for dear life just because we break the mid. Each level on the way back down can validate the move to continue to stay in the trade. So get through the mid and aim for the low down here. Get through the 1, 2, 3, 6 and aim for the midpoint of the gap, or even just Friday's high if you want to go for that. Maybe the big options level 68.50, because that's a valid level to target. So get through 60 to get to 50. From 50, you got the 42 old school cog line, and then the midpoint of the RTH of Friday, 26, and then 12, another cog line. No reason to believe that we're going to get that weak, right, to get all the way back inside of Friday's range. Because I'm not calling for a crash and burn here. I just think that we're primed for a reversal here, and it's set up as a fake break fast failure, or a blow off top, or capitulation high, or whatever you want to call it. Every single tool says we're going higher today. The perfect example of a breakout rally day. But I'm calling BS. All right. So when you have these sectors all up more than 0.5%, that's the checklist you would want to see for a really good rally day. And if I'm wrong, we're going to break to the upside and get into 69.25, 69.50 today, right? Easy. Nice expansion to the edge of the weekly expected move, and I'll be wrong. Trust me, it won't be the first time I've been wrong. So that's what I got, guys. Be careful, be safe. Have a good trading day. Don't forget, we got auctions today. I'll see y'all tomorrow.